Hi everyone, welcome to Chapter 10. This is Managerial Accounting. I'm working with the Cengage textbook. Today we're going to talk about decentralized operations. So as you see here, this slide provides you with benefits and negatives regarding decentralization. Advantages allows managers that are close to the operations to be those that make the decisions. Good training. Since those managers are so involved and they feel as though they are making a difference, it helps with the success of managers and they stay. Ultimately, the disadvantage could possibly affect the profits of the company, and there could be some duplication on certain assets and expenses just because instead of seeing a bigger, broad picture, they're allowing each individual department to make those decisions. So in this type of decentralized business, accounting helps managers to control and look at their responsibilities, which we call responsibility centers. There are three types of these centers: cost centers, profit centers, and investment centers. So cost centers, those that are helping to sustain those profit centers. The profit centers, of course, have the responsibility over revenues and cost, and then those investment centers that have not only responsibility over revenues and cost, but also investments in cash. So what's a disadvantage? Well, it can at times duplicate the various assets and expenses of a company. Now, cost centers can vary in size from a small department to a huge plant. And cost centers can exist within other cost centers. So responsibility accounting for cost centers focuses on controlling and reporting various costs. This next slide is going to look at some cost centers. So here you've got the university as a whole. Then you've got just the College of Business. And then within that College of Business, you have the Department of Accounting. The reports on this slide show the budgeted costs and actual costs along with the differences. Each difference is classified as either over budget or under budget. These reports allow cost center managers to look at areas of significant differences. So as you see in this slide, responsibility accounting reports are summarized for higher levels of management. Let's start with a few exercises here so we can get a feel of budget performance for costs, reports for cost centers. Partially completed budget performance reports for Delmar Company, a manufacturer of light-duty motors, is shown here. Our job is to complete the budget performance reports by determining the correct amounts for the lettered spaces and then compose a memo explaining the performance of just the production division for the month of June. And so here we have what the actual and what the budgeted is. And we see the a couple items that are filled in, but then we have to go in and fill in the difference here, okay, on the different aspects. So first of all, the budget performance report for A, for the chip fabrication, that figure there for the month ending June is going to be $4,300,000. For B, this budgeted figure is $4 million. And you can see how we're coming up with that. For C, we are over budget $300,000. For D, we show the actual cost of $8,515,000. For E, the total budgeted cost are $8,200,000. For F, we were over budget $375,000. For G, the total that goes into the Western Division here is $8,515,000. The budget for the Western Division is $8,200,000. We're pulling from what we've just finished. For I, we have the net of the over budget less the under budget of $315,000. Then for J, we've got a total here of $18,890,000. For K, we have a total of $18,650,000, and then for L, we've got a over budget of $315,000. Profit center managers have the privilege, I should say, but responsibility and the power for making decisions that affect the revenues and costs, which ultimately means the profits. Profit centers can be divisions, departments, or they can be products. Now, responsibility accounting for profit centers focuses on reporting revenues, expenses, and operating income. So, responsibility accounting reports for profit centers look like income statements. That's what they're going to be. The profit center income statement should include the revenues and expenses that are only controlled by the manager. Controllable revenues are revenues earned by the profit center, and controllable expenses are costs that are controlled by the decisions of the profit center managers. So the controllable expenses can include direct operating expenses. Profit centers also have expenses provided by various support departments, such as the research and development or legal department, telecommunications, IT, facilities, purchasing, advertising, payroll, transportation, HR. So they're indirect expenses to a profit center. A profit center's manager has control over support department expenses if the manager's free to choose how much service is being used. If that's the case, then support department allocations are assigned to profit centers based on the usage. Nova Entertainment, a diversified entertainment company, has the following two operating divisions: that are organized as a profit center. The revenues and direct operating expenses for the two divisions are shown here. And the operating expenses consist of direct expenses such as wages and salaries of the division employees. So NEG's support department expenses are shown here. We've got our purchasing, payroll, and legal. The cost driver for these support departments is the measure of services performed. So for purchasing, it's requisitions. Payroll, it's number of paychecks. Legal are billed hours. The services used by the theme park and movie division include the $25,000 purchase requisitions. For the movie production, $15,000 purchase requisitions. For payroll, 15,000 paychecks in total. And for number of hours billed, we've got 1,000 hours billed for the legal department. The rates at which services are allocated to each division are called the support allocation, department allocation rate. So we take the total expenses for each department, the support department, and we divide it by the usage. So here you see if the purchasing department has $400,000 in expenses and there were a total of 40,000 purchase requisitions, we'll allocate $10 per purchase requisition. For payroll, we've got $17 a paycheck, and for the legal rate allocation, it's $250 an hour. So those services used by these divisions get multiplied by the support department allocation rates, then determine the support department allocation. So as we're going to see in this next slide, how the support department allocations for this division plays out. So the theme park division employs a lot of part-time employees who get paid weekly. As a result, the theme park division has a lot of paychecks and incurs a $204,000 payroll service department allocation, where the movie production division has more permanent employees that get paid monthly. Therefore, the movie production division only has 3,000 paychecks and incurs a payroll support department allocation of just 51,000. Okay, so let's look at this exercise where we have our divisional income statement. The following data were summarized from the accounting records for Gonzaga Industries for the year ending November 30th, 2028. We're supposed to prepare divisional income statements. So as you see here, for the commercial division and then for the residential division, we'll break down the sales for each, the cost of goods sold, the gross profit, admin expenses for each division. Then we've got our operating income before the support department allocations. And we take into account the support department allocations to come up with our operating income per division. Let's look at some more here. Here we have, for each of the following departments, identify a cost driver that could be used for allocating the support department costs. Legal, of course, hours. Duplication services, pages copied. Electronic data processing, memory usage, CPU time, or printed pages. Central purchasing would be requisitions. or purchase orders, telecommunications, number of phones. Accounts receivable could be based on either the number of invoices or the number of customers. Exercise 10.6. Varney Corp., a manufacturer of electronics and communications systems, allocates computing and communication services department costs to profit centers. The following table lists the types of services and cost drivers for each service. The table also includes the budgeted cost and quantity for each service for August. One of the profit centers for Varney Corp. Is the communication system. Assume the following information for the communication system. They've got 2,500 employees, 20% are office employees. All of the office employees have been issued a smartphone. 95% of them have a computer on the network, and of the employees with a computer, 100% of them have email accounts. The average number of help desk calls for August was 0.6 calls per individual with a computer. There are 400 additional printers, servers, and peripherals on the network beyond the personal computers. So we need to determine the service allocation rate for each of the services for August and how much goes for this specific division. So with the help desk, $90,000 for the cost at 3,600 calls gives us $25 a call. The network center budgeted $120,000 at 1,500 devices gives us $80 for device monitored. Electronic mail, $160,000 at 5,000 accounts is $32 per email account. And then for smartphone support, $72,000 for the cost at 4,000 smartphones gives us $18 per smartphone. So that which is going to just come the 2,500 employees that the help desk at 20% times 95% at 0.6 per call at the $25 mark per call is $7,125 for help desk. For network, we'll take again our 2,500 at 20%, 95% plus 400 at the $80 per device gives us $70,000 for the network allocation. For the electronic mail, we'll do 2,500 employees at 20% are in the office, 95% have computers, and 100% of them have an email account. At $32 gives us $15,200. And then the smartphone looks like 20% are office employees that have a smartphone. $18 gives us $9,000. So these are the costs that will be allocated for this department from the various support departments. Here we have Horton Technology with 2 divisions, consumer and commercial, and 2 corporate support departments, tech services and purchasing. The corporate expenses are shown, and the other corporate administrative expenses include officer salaries and other expenses required by the corp. The tech services department allocates costs to the divisions based on the number of computers in the department, and the purchasing department allocates costs to the divisions based on the number of purchase orders for each department. So the support department allocations of the tech services department and the purchasing department are considered controllable by the divisions. Corporate administrative expenses aren't considered controllable by the divisions. The revenues, cost of goods sold, and operating expenses for the two divisions are shown here. We've got to prepare divisional income statements for these two departments. So for the consumer division, we show our revenues of $15,500,000. For the commercial division, $33,250,000. Then we take our cost of goods sold, our gross profit. From there, we'll take our operating expenses to come up with our operating income before support department allocations. From there, we'll take our tech services department and our purchasing department. As you see here, the tech services department, $1,170,000 for the tech, divided by 1,800 computers. But the consumer division has 1,100 computers, so that will be allocated $715,000. For the commercial division, they have 1,800 computers. They have 700 computers, so they'll be allocated $455,000. For purchasing, we've got the number of orders. The consumer division had 12,000 orders. The consumer division had 4,000 orders, a total of 12,000 orders. Commercial division had 8,000 orders. So we will take that and record that for each department. An investment center manager has the responsibility and authority to make decisions that affect the cost, the revenues, but also the assets invested. Because investment center managers have responsibility for revenues and expenses, operating income is part of investment center reporting. Since the manager has responsibility for the assets invested, the following two additional measures of performance are used. We're going to talk about return on investment and residual income. We're going to look at this at DataLink, a cellular phone company. So if we use only operating income, the central division, as you see here, is the most profitable. But operating income does not reflect the amount of assets invested in each center. For example, the central division could have twice as many assets as the northern division. For this reason, performance measures that consider the amount of invested assets, such as the return on investment and residual income, need to be used. So we look at return on investments that considers the amount of assets that are invested. And we look at that as operating income divided by invested assets. The higher the return on investments, the better the division is using its assets to make money. The return on investment measures the income on each dollar invested, and as a result, the return on investment can be used as a basis in comparing divisions with one another. So although the central division generated the largest operating income, its return on investment is the lowest. It's sitting at 12%. So relative to the assets invested, the central division is the least profitable division. When you compare it to the other divisions, the northern division is at 20% and the southern division sitting at 15% return on investment. Profit margin indicates the operating profitability by computing the profit earned on each sales dollar Investment turnover indicates operating efficiency by computing the number of sales dollars generated by each dollar of invested assets. If a division's profit margin increases and all other factors remain the same, the division's return on investment will also increase. If a division's investment turnover increases and all other factors remain the same, then the division's return on investment will increase. Here, the northern and central divisions have the same profit margins. They're at 12.5%. But the northern division's investment turnover of 1.6 is larger than that of the central division's turnover of 0.96. So by using the invested assets a little more efficiently, the northern division's return on investment, as you see, is now 20%. It's 8 percentage points higher than the central division return on investment of 12%. The southern division's profit margin of 10% and investment turnover of 1.5 are lower than those of the northern division. The product of these factors results in a return on investment of 15% for the southern division, but at the northern division sitting at 20%. Even though the southern division's profit margin is lower than the central division's, its higher turnover of 1.5 results in a return on investment of only 15%, which is greater, though, than the central division's return on investment of just 12%. So the northern division's profit margin remains the same at 12.5%. If the investment turnovers increased from 1.6 to 1.76, then we're going to see an increase of 10%. That 10% increase in investment turnover increases the return on investment by 10%. So it goes from 20% now to 22%. It's gone up 10%. So DataLink should give priority to expanding operations in the northern division because it earns a higher return on investment, 20 cents for every dollar invested. The disadvantage of the return on investment as a performance measure is that it could lead to divisional managers rejecting new investments that could possibly be profitable for a company as a whole. So DataLink has the following returns on investment for the northern division. We've got our current return on investment at 20%. The minimum acceptable return on investment that's agreed upon by management is at 10%, and we expect 14% for new projects. The division manager could decide to reject it even though the new project's expected return on investments is exceeding the minimum return of 14%, because currently it's sitting at 20%. Residual income is beneficial in overcoming some disadvantages of the return on investment, because residual income is the excess of operating income over a minimum acceptable operating income. We're going to see this. The minimum acceptable operating income is computed by multiplying the company's minimum return on investment by the invested assets. So the minimum rate is set by top management based on factors of cost of financing. And DataLinks said 10% is the minimum acceptable return for investment on these assets. So we'll see the residual incomes for the three divisions. So As you see on this slide here, for Exhibit 8, the Northern Division has more residual income, sitting at $35,000, than do the other two divisions, even though it has the least amount of operating income at $70,000. This is because the invested assets are a lot less for the Northern Division than they are for the other divisions. If the manager of the Northern Division is evaluated just on new projects using only the return on investment, the division manager might decide to reject a new project, because investing in the new project is going to decrease Northern's current return on investment, sitting right now at 20%. While this helps the division maintain a high return, it hurts the company as a whole, because the expected return on investments of 14% exceeds DataLink's minimum acceptable return on investment of 10%. So let's look at this exercise here. The excess of operating income over a minimum acceptable operating income is known as residual income. Okay, we'll look at some more problems here. The operating income and the amount of invested assets in each division of Stewart Industries are shown here. We're going to compute the return on investment for each division and then decide which one is the most profitable per dollar invested. So as you see, the retail division is sitting at 26%, the commercial division sitting at 20%, and the data analytics division is sitting at a 16% return. So clearly in this case, the retail division is showing the greatest percent return on investments. If we look at this information and let's come up with some other, let's take this information and determine the residual income for each division and which division has the most residual income. So if we have a minimum amount of operating income being 12%, then the retail division's residual income is sitting at $6,300,000. The commercial division is sitting at $5,040,000, and the internet division is sitting at $480,000. So clearly the retail division has the most residual income. We're looking here at income statements of the Consumer Product Division. The manager of the Consumer Products Division is considering ways to increase the return on investment. So we're going to use the DuPont formula for return on investment and determine the profit margin, investment turnover, and return on investment of the Consumer Products Division, assuming that $106 million of assets have been invested in the Consumer Products Division. And if expenses could be reduced by $5,300,000 without decreasing sales, what would happen to the profit margin, investment turnover, and return on investments? So here you see the return on investment. We're going to do profit margin times the investment turnover. Our profit margin is calculated by operating income divided by sales. So the $42,400,000 divided by our sales of $265 million yields 16% profit margin. The investment turnover is the sales divided by our invested assets. We've got our sales of $265 million divided by our invested assets of $106 million gives us the investment turnover of 2.5. If we take our 16% times our 2.5, we get a return on investment here of 40%. Now, what happens when we add some expenses? It said here, reduce. If we reduce our expenses for $5,300,000, so basically our operating income is going to go up by $5,300,000. So now that will be $47,700,000. Divide that by our sales. Instead of the profit margin being 16%, this then increases it to 18%, which would then change our return on investment to 45%. So it's going over 10% there. We're gaining an additional 5%. Because transfer prices allow a division's financial performance, setting transfer prices can be a tough situation for the managers of both the selling and the buying division. This is utilized when divisions within a company transfer products or render services to one another. There are three common approaches in setting these transfer prices. You can do a market approach, a negotiated price approach, or a cost approach. So, in this case, I guess I screwed up and don't know what I did with looking at how that plays out. Let me see. Let's just go here and I'll work with you here. So, in order to show how this plays out here, we'll see the various possible ranges of transfer price. So we can look at the market approach, the full cost approach, or a potential variable cost. When we use the market price approach, the transfer price is the price at which the product or service transferred could be sold to outside buyers. If an outside market exists for the product, then the current market price could be what you use. So assume materials used by Wilson in producing snack food in the Western Division are currently purchased from an outside supplier at $20 a unit. The same materials are produced by the Eastern Division, which is operating at full capacity of 50,000 units. So it can sell all its products to either the Western Division or to outside buyers. So a transfer price of $20 per unit, which is the market price, is going to have no effect on the Eastern Division's income, or for that matter, the total company income. So Western Division will pay $20 per unit for materials, which is the market price. So in this situation, the use of the market price as the transfer price would be appropriate. Wilson has two operating divisions, Eastern and Western, that are organized as investment centers. Condensed income statements for Wilson, and this is assuming there are no transfers between the divisions. Now, a negotiated price approach allows managers to negotiate among themselves a transfer price. The only issue is that the transfer price is going to be less than the market price, but it's going to be greater than the variable cost. So it's a middle place. Assume that instead of a capacity of 50,000 units, the Eastern Division's capacity is at 70,000 units, and it can continue to sell only 50,000 units to outside buyers. So, in this case, a transfer price less than 20 would encourage the manager of the Western Division to purchase from the Eastern Division, because the Western Division's currently purchasing its materials from outside suppliers at $20 per unit. But at the same time, a transfer price above the Eastern Division's variable cost per unit of $10 would encourage the manager of that Eastern Division to supply materials to the Western Division. So as you see on this slide, the divisional and company income statements, assuming that the Eastern and Western Division managers agree to a transfer price of $15. The Eastern Division increases its sales by 300,000, which is 20,000 units at $15 a unit. So it goes up now to 1,300,000. As a result, the Eastern Division's operating income increases by 100,000. As you see here, the 300,000 in sales minus those 200,000 in variable cost to then 300,000 in sales. Then we have a negotiated price approach. The increase of 100,000, as you see, shows by the transfer price, the 15 minus the 10, minus the variable cost per unit, at the number of units transferred gives us that $100,000 profit. The Western Division's material cost decreases by $5, so it goes from 20 now to 15 of the 20,000 units. So the Western Division's operating income increases also. The increase of the 100,000 in the Western's Division is, as you can see here, shown because the transfer price is going to be less than the market price that they're currently paying. When you look at the two, Exhibit 10 and Exhibit 11, ultimately, Wilson as a whole has increased operating income by $200,000. The overall company's operating income is going to increase. The negotiated approach only is going to apply when the supplying division has excess capacity. So if the division that's supplying does not have excess capacity, this isn't going to help. The supplying division cannot sell all its production to outside buyers at the market price. Therefore, a negotiated price will be beneficial in this approach. If actual costs are used, inefficiencies of the producing division are transferred to the purchasing division. So there's not a lot of incentive for the producing division to then be able to control costs. Which of the following is not one of the common approaches to setting transfer prices? The variable cost approach would not be the best scenario. Let's go back here. I had some problems here. I think we did those. I guess I screwed up. Make sure. But I had something in here I messed up on. Well, I look like we've done all these, so I apologize. It's something stuck in the middle here. Okay. Now we've done those. We've done all that. Okay, so materials used by the instrument division of Ziegler are currently purchased from outside suppliers at a cost of $1,350 per unit. However, the same materials are available from the components division. The components division has unused capacity and can produce the materials needed by the instrument division at a variable cost of $900 per unit. If a transfer price of $1,000 per unit is established and 75,000 units of materials are transferred with no reduction in the components division, current sales, how much would Ziegler's total operating income increase? How much would the instrument division's operating income increase? And how much would the components division's operating income increase? So as you see here, the overall Ziegler's operating income would increase by $33,750,000. You take the market price minus the variable costs, and at 75,000 units, that would be our increase. For the instruments division, we would take the difference between the market price and the transfer price over times the number of units transferred. And for the components division, we take the transfer price minus the variable units times those units transferred. So you see how the entire income is at $33,750,000, and you can see how that's broken down. Based on Ziegler's data in the previous exercise, assume that a transfer price of $1,200 has been established and that 75,000 units of materials are transferred with no reduction in current sales. Then what's going to happen? In that case, with a transfer price of $1,200, the operating income will show the market price minus the variable cost times the units transferred as the overall increase. And if we change the transfer price, we increase it, then you see overall the numbers are the same, but per department the changes occur. Any transfer price will cause the total income of the company. It increases if the supplier division capacity is used towards making materials for products that are ultimately sold to the outside. The transfer prices should be set between variable cost and the market price in order to give the division managers incentives they need. A transfer price that's set below variable cost is going to incur a loss, where a transfer price set above market price is going to cause the purchasing division to ultimately decrease its operating income because they could get it somewhere else. So as you see in this scenario, the operating income of $33,750,000 is going to be the same on this one, but basically within the departments the numbers are going to change. Franchises have a license or right granted to a group to market companies' goods and services. The franchisor is the entity that provides the franchise, while the franchisee is the entity that pays for the franchise. The franchise fee is often expressed as a percent of revenues earned by the franchisee. The franchisee invests in the property and equipment to deliver the franchised product or service, and the franchisor often provides support for the franchisee. The main benefit to the franchisor is an ability to expand the brand without investing significantly by themselves. From the franchisor's perspective, the return on investment should be increased by the low investment, so that DuPont formula would show a healthy profit margin combined with a high investment turnover. Hilton has company-operated and franchise-operated hotels. As you see in this scenario, the company-operated revenues and operating expenses and invested assets versus the franchised revenues and invested assets and general and administrative expenses. I hope this has been helpful, and I will see you next week.